Hello, thanks for having me. My name is Sergio Marrero. Talk about today about disruption in venture capital, managing partner of Rebel One. We're an investor network, an investor training program, and a syndicate. We backing the Rebels, early stage founders. But a little bit about my background. I have over 10 plus years of founder experience, TEDx speaker on different topics, covering at the University of Princeton, and run a live stream series where I interview a number of VCs and CEOs every week, and highlight them, and have been connected to a number of accelerators. Where this research started was at my time at the Harvard Business School and the Kennedy School of Government. To share more about that, what I did is I was looking at in the beginning, I was trying to understand how do we accelerate ventures that are really making a positive impact in the world, and then it took some time to do my thesis on startup studios. So there are these factories that are outputting startups at a rapid rate. And back in 2015 timeframe, there weren't many of them around the world, and now there's many more. But that's how this initial research started, focusing on how to innovate in venture capital. To share a little bit a story of how venture capital has not innovated as drastically, I show you this image of the whaling industry. The business model of venture capital actually stems from the 1800s, from the whaling industry, where a venture capitalist would garner money from wealthy families looking for a different return on their investment, and would bring that money together to back the entrepreneurs or the captains taking out several fleets of ships in order to hunt whales and bring them back. And the term and how they got paid, the venture capitalists, is they would get a share of the profit or a share of the carry. Carry comes from the term, it's the share of blubber that they can carry, whale fat, off the dock when the ventures were to return. So these risky ventures in venture capital in the 1960s really modeled after the whaling industry of the 1800s, and the business model of just taking share of profit and investing in early stage ventures really hasn't changed all that much. So just to share, it's a little ironic that we back early stage ventures that are innovating and pushing things forward, but aren't innovating and changing ourselves. And I'm going to share a little bit with you on what trends are disrupting venture. In order to do that, I used the framework from Clay Christensen, who was a researcher, and he was a professor out of Harvard Business School, and he created this diagram that showed, how over time you have performance on the left, and over time it goes up, and you have these different qualities of performance. And the disruptive technology in the beginning isn't good enough to meet the needs of the low quality needs of the market, and then again over time goes up to usurp the current competitors. And to give you a real example of that, out of Clay Christensen's research, he talked about mini mills. So the concept of mini mills were steel mills used to take billions of dollars back you talk about the mid 1900s to create steel. Different types of steel, rebar that goes into construction, angle iron and structural that supports buildings, and then sheet steel is the highest quality, where it's thin layers to make cars, right? In the beginning, these mini mills were a couple $1 million instead of billions, and then over time they got more and more efficient. The steel became of higher quality, and they usurped the current large steel mills, and then the whole steel mill industry really collapsed, and the mini mills replaced all the other steel mills. You might say, okay, I'm not familiar with steel mills. What are other examples? I'll rapidly go through them. You think of cell phones. In 1985, that's when mobile phones first came on the scene, and over time they didn't have the coverage, as current phones do, and eventually proliferated to today to replace, even in other countries that aren't didn't have access to, call it the internet, and prosumer devices have proliferated and really replaced line phones, and in some places are replacing computers in some countries, right? You talk about Netflix. In the beginning, they just delivered DVDs, and then over time, created online streaming to even usurp their market and disrupt it, and now have challenged major content houses and media producers across the world. So that just gives you a sense of how the disruption model, works. So the real question is, in venture capital, what are those rungs of quality, right? And what is poised to disrupt it? So first, there is providing capital, period, right? Then you have venture capitalists that also, they not only provide capital, right, but there are some others that are providing marketing, media, support, this customer discovery and development. The next rung are the support services, right, where angels probably land in the customer development and discovery. The next support services are really small, venture capitalists to larger stage venture capitalists. And then you have the larger funds that provide multiple rounds of support and a suite of services. And the question is, what is poised to just not only provide capital but increase over time? And I'm going to share some of those with you today. So first, I would say an example, a trend happening right now are rolling funds. These are what they're doing is they're increasing the speed at which early stage fund managers can create a fund and deploy it to early stage founders. Even though the number of early stage venture funds has increased from about 100 to about over 1,000 in the last 7 to 8 years, this will increase the proliferation because LPs can sign up and subscribe to a fund, not necessarily dedicate over a 5 to 10 year period. It's a shorter horizon, and it's a very it's just an easier structure to execute. Next, there's another trend of venture studios. These are funds and then also product development houses that are rapidly launching products that each stand up as their own startup. What they're able to do, because they're providing all that, they're increasing the speed and also the support. They're able to take a larger chunk of equity, which increases the return on investment. They are risky and require specialized knowledge, but this is another trend in the space. The third and the last that I'll talk about today is crowdfunding. Even though people may shy at crowdfunding, this is they're probably best poised to disrupt venture capital. And to give you a sense of that, they are even innovating on the model of venture itself. So while they'll get, you talk about in the U.S., these crowdfunding and syndicates, even syndicates that are made up of accredited investors, right? There's about 7,000 people in the U.S. making over the 200,000 to 300,000 a year. They're able to bring together billions, and that's increasing at double-digit rates every year. And because they're a little bit more flexible and on a deal-by-deal basis, the economics are actually better. They're able to move faster, and they're really using new tools and technology in order to increase the user experience for potential limited partners. So that's just a little taste of what the disruptive model of innovation. Which one will it be? Rolling funds, venture studios, syndicates, maybe even other areas such as digital assets. At this time, it's too early to tell. But thank you for listening. This is a little bit more from Rebel One. We also run an investor training program and have our own network. So again, please join us at it's rbl1.com/angels if you're interested in our program. rbl1.com/invest. And Tim, thanks for putting this together and having me today. Appreciate your time. So.
Thank you, Sergio. That was a great presentation. Honestly, absolutely loved it. And even I, person who considers himself professional in this field, had no idea that the carrot interest can be traced back to the whale hunting. So thank you a lot for that, and have a good day. And here we're moving on to the next speaker of ours, who